guys, this week is ending in the red for all the indices. And I'm really glad that we have been consistent about saying, hey, you got to make sure to hedge out. We got 2 weeks to earnings. And I don't know, every day that passes, it's a really concerning environment that we're getting in, because even if US companies do okay, we still got to get past the noise of what they're going to guide to as well. And so, I do have concerns, even though I don't think that the US economy is nearly as bad as it's being portrayed. I think the European economy is actually way worse than people are portraying it. Nonetheless, I just want people to be hedged or just have some cash. If it's burning a hole in your pocket, and put it in we have a dividend list of names that is up on the system in YouTube, or just come find us. We'll let you know what we like in the way of dividends, but now is not the time to be bold. I think you got at least a few weeks, because I'm really worried, especially with the banks coming out first, that either earnings will be bad or guidance will be bad. And either one is not fun. Now, today we're going to talk about those companies that reported earnings in consumer staples, which is Lamb Weston, Constellation, McCesson, and Conagra. And I got to say, I would say it's kind of mixed, but let's past performance, not indicative of future returns. I'm going to share my screen and let's take a look at what it looks like today. If we look at the major market indices, oil finally dancing back over 90, because let's just face it, this is a problem, this OPEC / NRG / all that stuff. It's not good. I think it's strange that we are pretending like oil should be at 91, but that kind of is what it is. Widen this out a little bit. S&P down, so you can kind of see all the indices down almost 3%, really giving it almost all back. If we look at this on FinViz, one of my favorites, we can always see that the picture of what's actually up. So we do have a few names in energy dancing back and forth, a few names in large cap they're not, but really, I mean, this is a sector rotation into energy. There is differentiation between these. I still prefer the US onshore producers more than all the offshore stuff, because there's a lot of extra, for lack of a better way to say it. Yeah, most everything is given a bunch back. Tesla, my suspicion is it's going to be down for a while as people try to figure out the financing aspect of what's going on in that transaction. And so I want to actually talk a little bit about these food companies that came out. You had Conagra, Constellation down a bit. I mean, in a red day, it's very hard to tell how the market truly is reacting to these, but I'm going to say poorly. I would say that the 3 companies have pushed pricing. 3 of the 4 companies pushed pricing through this. McCormick Schmidt did not, the spice company did not push pricing through aggressively. That was their whole shtick. But I can't see that that's not going to continue in the future, that they will have to ultimately do it. All of them reported inflation through next year, 2023, in the low teens. They're hoping that they're not really suggesting that it will abate, but they believe that the bulk of the inflation will happen in the first 6 months. And then we'll just have to see how South America did, and all of them are like barring any major weather issue, so that you can kind of see what actually harvests out. But nobody's confused that the harvest in the United States and the Northern Hemisphere countries are going to somehow take us into this beautiful territory of abundance as relates to food grain. So just realize that was across, I think Lamb Weston and Conagra both were expecting about low teens inflation, and they have to push that through. Okay. Volumes for everyone was lower, which is kind of something to note. So it truly is, they're currently making their number on pricing. And I just want to show you a little bit of items from it. Here's Lamb Weston, grew sales 14%. Volumes were kind of flat, right? Like they weren't up 14%, I'll tell you that much. And because this one, again, is a turnaround story, the CEO's in there since 2016, but there have been some really weird, like he's really had to transition this and ramp this a particular way, because Lamb Weston, being in the potato business, is so leveraged to restaurants, so leveraged. You think you go out, you don't eat fries at home. At least I don't. Maybe you do. Invite me over, so to speak. Most people are eating French fries outside. And then when you get takeout, it's not as obvious ticket item, whereas it might be a more common item if you're dining out. So realize that is why you're getting this this up 14% is just the pickup in restaurant, from the restaurants. And yet they're saying their volumes didn't show this a magical liftoff, just FYI. Additionally, the EPS, because they finally got a bit more volume, they got a bit more, well, they actually just improved gross margins and a number of other things. You did get a lot of leverage there. So Lamb Weston was a clean quarter, and yet they're like not trying to be too aggressive on how they think about the next year or so, because they are concerned about all the things that everyone's concerned about. Here's what it looks like. They have a global segment. This really is global food companies. So like McDonald's, et cetera, not all this stuff is coming from overseas. You can see the volume numbers there down 2%. So it's price and mix. So upselling a bit. Food service, this is like local US restaurants. Okay. You can see the volume numbers. And then the retail segment, which is like actually us buying it for our house, also down. So not great if you're thinking, oh my gosh, demand is so phenomenal. No, this is just people trying to feed themselves and their families. And this is what's happening. Conagra was a mixed result. On none of these can I be truly bullish, because there's just too much in these numbers that are the uncertainty is so great and this market is so weird. I'd rather have cash right now until we get into some of the names that are a bit more controversial, that if they report a particular way, either you'll get a massive downside opportunity or a massive upside opportunity. So no, but I do think this one's very interesting. Sales up 9.7%, EPS adjusted up 14%, adjusted operating profit. Here's the deal that makes it hard is when you start to run through the numbers, you get like these really weird one-off line items that take everything, like although they're saying EPS and operating profit up 6.2%, when you go to look at the actual income statement, you'll see the exact opposite of that. And it has to do with which companies and parts are being wound down. Namely here, this is Bird's Eye. I don't know if you guys go to the frozen vegetables section of your grocery store, but Bird's Eye, that just isn't like they're taking an impairment charge here on that business. So there's a lot of extra banking, restructuring, reorganization activity that somehow is here, not really wonderfully walked through so that I could even make sense of it with Conagra. Here's what the charges were. I mean, to me, this isn't an outstanding charge. It's not gigantic, so it's weird. And it certainly doesn't make up for, this. I mean, there's just too much going on. And then, if we look at this, you can kind of see that if we're going to give them credit on the adjusted operating profit numbers, then most businesses are doing well. International for them is frozen international food. So, if you're going to get something that's from Latin American food, like a really, or La Choy or something like that, the Asian frozen food section, that sort of stuff. So that's all, that's what that is not doing quite as well. But you can see where things kind of lay out that way. And then finally, on Constellation, again, this was a good quarter. You can see good top line growth in like, 700 million out of, so really strong top line growth, really strong sales, almost 15 something percent. But operating income is almost a double. So that's great. But you have this income from unconsolidated investment loss of almost 2 billion. I think that comes from how they're looking at divesting the lower end alcoholic beverages, which I'm kind of sad because I did actually like some of those wines. Listen, I'll drink sometimes just grocery store wine. I'm not that fancy, you know what I mean? But they divested a lot of their a variety of different brands that in theory were lower end. And so as a result, you've got a cloudy mess in Constellation as well that makes it really hard to see. And that really thematically is what I mean by these businesses. This, if we're to follow what the Staples are doing, which is they are basically reconfiguring their businesses for something else, and they're going ahead and getting rid of businesses that are probably going to lose money during the recessionary period that everybody believes strongly that we're going into. But also they're just going to go ahead and get rid of the things that they would have gotten rid of to come out a leaner company. It gives you a sense of a very particular type of financing, let's call it, environment. So we had mentioned like many moons ago, this idea of take private. So it could be that when they're divesting it out, that it's a private equity firm bringing it in and holding it through the market volatility. Because remember, private equity doesn't absorb volatility like public market companies do. It could be, so that could be what we see for the companies that do that type of financing, which would be your broker dealers. Now, just so you know, that type of business, it makes money, but it doesn't make money like bringing something public makes money or something like that. So it is a lower relative margin business and lower size business in the way that it looks. So that does make me a little concerned for what I'm going to see there. Additionally, it is a little bit funky how much of this restructuring activity is going to go on. And what does that mean as relates to corporate earnings, as relates to going into this next quarter? I don't think it's good. It's really the way to think about it. And with that, let me just pause and take questions. Keep it kind of weak on a Friday.
Yeah. Okay. Are you seeing strength there or weakness?
In staples, I'm seeing a flat situation where they're going to charge us as much as the consumer will bear. And then they're going to do the best they can to just keep and all they're trying to do is hold gross margins and operating. If not, they're either trying to get it through gross margin by charging us more, or they're going to try to do through operating margins. The operating margins is going to be hidden in basically restructuring the company. So they'll be like, oh yeah, the business looks better from an operating or gross margins perspective, but you're going to have these weird corporate charges. So they're hoping like the investor just pays attention to the adjusted number and isn't like, well, what the hell was this? What the heck was this banking number? Do you know what I mean? I think that's the strategery that the food companies are going to do, the staples are going to do, and then we'll see what everybody else does. But I'm not seeing strength. And the worst part is they're not even pretending like inflation's not happening next year and that they're not going to try to charge us more. So this speaks to this idea that somehow inflation's going to wane. You know, I think sometimes if we were a country where most people bought stuff from the farmer, maybe, but most people do not buy stuff from the farmer. Most people buy stuff through a packaged good and then eat it. And that's not going to change in the near term. Like they were even talking about, Constellation was like, look, we haven't had to do a lot of promotion this last quarter. We always do promotion in the fourth quarter. So we will continue to do promotion. But the fact is, I think that there's a lot less promotion in the fourth quarter because volumes are down and because they can, for lack of a better way to say it.
Right.
Yeah.
A lot of people are recommending Meta. I just don't get this.
Yeah, I know. You know, when it went down to 130, do I think we continue to push on the short? No. But if it tries to dance back up to 160, I think we start to consider what to do there. You know what I mean? Like right now, this market is so.
They're recommending buying it. I mean,
like really buying it, like really buying it.
Because of their earnings multiples. But I mean, that's not the company anymore. I mean, Meta is
in order for you to understand how earnings multiples work.
Well, I know how earnings multiples work, but if a company's completely changing, those earnings multiples don't apply anymore.
Yes. And also, look, I think it's good for a trade. At 130, do I think that people will try to trade it up into earnings? Yeah, I think people will try to trade it up in earnings. Do I think that this earnings season is going to be great for Meta? Hell no, absolutely not.
Okay. So what do you think earnings? What do you think earnings will do in 2023?
I mean, I think we still don't know. Like he's got to transition that model, and he's not growing revenues right now. So he's got to do it out of cash, basically, or a concept. Let's just use the concept of cash because, of course, he can do it more than one way. Of course, okay, guys, I get it. But like he's got it. Yeah, he's got a company that's starting to slow to it. There, you know, you got negative growth on revenue. You got a really tough operating environment. Let's call it that globally. You got currency because you still have to be, look, it's not a foreign company. So your stuff has to be, you're getting foreign dollars and they're going to have to grow against US dollar comps. And that's not great. Do you know what I mean? So in general, think about it this way. Your Europe business, no matter who you are, your Europe business is worth 6% plus less than it was last year, depending on how you were hedging it out. So that already has, unless you're like growing way past 6% or whatever the differential is on the mark on the day that you want to take it is and which country it is. If you're not growing past that currency fluctuation, you're already in the hole. So it's easy for me to know that they're going to be in a hole, right? It turns out Microsoft, Google, like, Apple, not so much, but Microsoft and Google, they are absolutely growing at 30% top line growth, 15% top line growth, even with the currency risk that they had, they still posted a good growth number. And then if you did currency neutral, which sometimes people produce, they posted an even better number. So, your costs aren't going down because it turns out if you think the Americas can't vary their labor cost easily, have a look at Europe, for lack of a better way to describe it. You know what I mean? Your European executive may be paid less than your standard New Yorker, but you can't get rid of them, with all due respect, even if you wanted to. I mean, maybe you could pull out of Europe, which is, so like operating costs in Europe and developed markets Europe is not cheap. I don't know what people are thinking. So, that's my long-winded way.
The only way he can improve multiples is drastically cut expenses.
Yeah, he's going to have to come up with a true growth business. And until the fourth quarter is done, I think that's aggressive. Even all the respect, all of the respect for his talent that I have, all the brilliance that guy is, because he is truly brilliant. Let's call it what it is. But do I think this quarter is going to somehow magically produce unicorn results? No. What is wrong with, So yeah, that's all I got. I could be proven wrong though. Look, I'm prepared to just suck it and be like, my bad. He's the most amazing human being in the world. But this is like unfair. If people are expecting him to somehow magically pull it out of a hat in the third quarter, not even the fourth quarter. We're not even talking about holiday season, right? We're talking about this summer. He magically pulled it out of a hat. What's wrong with you? I mean, it might be that they think that he's going to guide something really amazing for the fourth quarter, but boy, yeah, I don't get it.
Okay, I don't.
I'm with you.
Okay, yeah, that's
Yeah, it's kind of a sad day, I guess, in that regard. Like, I really do think every day that passes, the geopolitics is what's bothering me more than, like, I usually can separate the geopolitic noise from, can these companies still earn money? But the geopolitics has gotten so bad that there's no possible way as a CEO you're going to do anything but guide downwards. And even though the street has guided down 6%, according to Wall Street Journal and all those powers that be, I don't know if it's going to be enough, because I don't know what you do if you're a CEO of a company right now. Do you just remove guidance outright? What do you do?
Yeah, Apple did that, but
Yeah,
I don't know. I think you need to guide. I mean, it's investors like that.
yeah.
But I mean, the only thing holding this market up is earnings now. So interest
That's
rate,
it. It's so true.
no longer pivot, no longer employments. Now you've got to look at earnings.
Yeah. Did these companies make money or not?
Right.
And boy, even with earnings, from a CEO strategic perspective, how do you guide? How do you talk to your investors given what's coming up? My suspicion is that these earnings calls are going to be some of the most bearish, set guidance lower for next year, and then outperform if you can sometime in the first or second quarter. Do you know what I mean? Like, everybody knows that there are a couple potential rainbows on the horizon, but
Right.
the earliest horizon that people are really talking about is November. It's not, and that's not going to help out because you got a bunch of companies reporting from October through the beginning of November. Look, the only place where there's a rainbow still overhead is oil and gas and fertilizer. It's horrible.
Yeah, oil.
Yeah, it's not even metals right now, because if the economy slows down so aggressively, metals is not going to do okay.
Yeah, oil's been wonderful.
Yeah. And I still think people should be there. I think that, yeah.
Winter's coming.
Yeah, winter is coming.
And our administration, they couldn't have done anything. They did not do anything right as far as energy goes.
I know it's really bad. And I know, like, we try to stay non-political, but like, there were so many things that were so like reactive, I want to say, and not really strategically thoughtful. through the entire thing. It's just been such a poor series of economic, of policy decision. And I know there's some people that are like, well, what would you want him to do? Would you think he was going to do, or whatever. And I'm just like there, I mean, when
Well,
oil
not shut down
was
the
at
pipeline.
30, but then when oil was at 60, he could have taken a series of actions. You know what I mean? It's all really bad. But I think as much as our, let's call it government, missed this one, let's call it, the Europeans, wow, they really didn't think it through.
Okay.
Wow.
Thank you so much, May.
All right.
Brilliant.
Take care.
Thank you. Bye.
Bye.